Good morning, everybody. I hope you had a terrific evening last night and caught that harvest moon that's out there. It's absolutely just stunning. I wanted to talk to everybody a little bit this morning about interest rates, the ugly elephant in the room, if you will. We talk about this every single day, of course, doing mortgages, and people will call up, and the first question that they ask is, what's the rate today? So I wanted to kind of take away some of the mystique about the rates and help everybody increase their understanding and expectations of this. So, you know, the internet has been an amazing source for all of us in our businesses. It helps us grow, and it gives everybody access to a lot of information that, you know, many years ago we didn't have. The downside to that is that sometimes we find information that's not relevant to us, and it's not actually going to give us the accurate information or details that we're looking for. So there's a lot of variables that come into play on the interest rates. One of them is your credit score. That's a really critical key component. The higher that credit score is, the better interest rate you're going to be able to command. The other things that come into play are adverse credit events that have happened in your life. If you've ever had a bankruptcy, a foreclosure, short sales, something along those lines, even judgments and collections can affect this. Your loan to value. So what the loan to value is I'm buying a $100,000 house and I'm financing 80% of that, so I'm getting an $80,000 mortgage, just for easy numbers to work with. It's the percentage of the purchase price that you're borrowing. The size of the transaction, the 250 range is about the sweet spot. If you've got the highest credit score in that 250 price, or I shouldn't say price, but the mortgage amount, that's going to get you some optimal terms. The occupancy, if you're living in the property, if you're using it as a vacation home or you're using it as an investment property, that can affect the interest rates. The type of the property, if you're buying a condominium or a townhouse or a single family, there can be some fluctuation in those rates and terms. And then down to the documentation that you're providing to get the loan qualified. So there's so many different variables in those terms that are out there. And it's, you know, I always find I'm a person that when somebody calls me and asks me a question, I want to always give an answer that I'm going to be able to sink my teeth into and know that if you show up with a contract in 10 minutes, I'm going to actually be able to perform on those numbers that I'm giving you. So I'm always skeptical and hesitant to say, oh, the rate's this or the rate's that, because I don't want to give you a number that's too low, but I also don't want to give you a number that's too high. I want to give you a number that's actually relevant to you. So as you're out there, if you've got these questions and you're trying to figure out, you know, hey, or we're buying a home or we're thinking of refinancing, but we really don't know what those numbers are going to be, you know, give us a call. Let us talk about your specifics, and we can help you come to those conclusions and get you actual specific feedback on those numbers. Not all numbers are created equal. The other variable that can come into play is, are you paying fees to get into those interest rates? So a lot of times the rate, you know, maybe the rate is 4.75, but if you're having to pay a point to get that 4.75, that may or may not be in your best interest. So understanding how that works, what the difference is in the monthly payment for a slightly higher rate without that fee, is it the long-term benefit to pay the fee or to pay the higher interest rate? We can help you navigate all that. So always free. Feel free to give us a call at 561-207-8049. We look forward to helping. Thanks. Have a great day.